Most people think money is created when the government prints it, but that's only a tiny part of the story. The real magic happens inside the banking system. Here's the simple version. When a bank gives someone a loan, it doesn't usually hand them money that was sitting in a vault. It creates a new deposit in that person's account. In other words, the loan creates new money. If you borrow $300,000 to buy a house, the bank adds $300,000 to your account, and suddenly, that money exists in the economy. But here's the catch. The debt is created with interest attached. So the money supply grows, but so does the obligation to pay back more than was created. That's why modern economies are built on credit. More loans mean more money circulating. Fewer loans mean money starts disappearing as debts are paid down. Now, who benefits? First, banks benefit because they earn interest on money they helped create through lending. Second, asset owners benefit because newly created credit often flows into things like real estate, stocks, and businesses, pushing prices higher. If you already own assets, inflation in asset prices can make you richer. But if you mainly earn wages and hold cash, you may feel like you're falling behind because the cost of homes, cars, education, and everyday life can rise faster than your income. Governments also benefit because a credit-based money system makes it easier to finance spending through bonds, deficits, and central bank support. But regular people often only see the downside: higher debt, higher prices, and the feeling that money is losing value. So the big lesson is this: money is not just printed, much of it is borrowed into existence. And in a system where money is created through debt, the people who understand assets, credit, and interest usually end up better protected than the people who only save cash and hope it keeps its value.